Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pogmanik. How you doing, D?
Hey, Will, how's it going?
Good. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your RIA, call your broker. That's what they're there for, to give you advice, provide with guidance. There's the disclaimer.
Awesome.
Okay. Let me share my screen. If anyone's joined us for the first time, we do this show every morning to help answer any questions you have about Market Chameleon tools, data analytics. If you want to discuss strategies or maybe something unusual you've seen, or have a question related to the markets, you're welcome to ask that question or come on the show and ask that question. One way is to put that question on the live chat on YouTube. Will's watching it, he'll read it back to me. If you want to come on the show and ask your question live, we also provide a link to Zoom. When you click on that link, it takes you over to Zoom. Once you're in Zoom, click on raise your hand. When you do that, you don't have to turn on your video camera, but once we let you in, everybody could hear you. You can ask your question live, direct. You can navigate as to what you're looking at. Everybody will be able to see it, but that benefits the entire community. While we're waiting for any questions to come in, we'll start out taking a look at the pre-market report, see if we could get some insights, what's going on in the trading prior to the market open. If we don't get any questions, I'll navigate to some other reports to see if we can get some insights from them. Okay, so let's start out with the pre-market report, Will, and then you'll let me know if somebody has any questions.
Perfect.
Okay. So on the pre-market report, these are stocks that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers and biggest percentage decliners. Here I see 71 stocks made our percentage gainers list and 125 on our percentage decliners list. From this perspective, we were looking like a bearish bias at the open. If you look at this list, you will see that it has small cap stocks in there, ETFs, leverage products, could have closed-end funds in there, preferred stocks, rights, units, anything that's trading on the major U.S. exchanges. And if it's trading in pre-market hours and it meets our thresholds, it can make this list. And we want to narrow down this list to a smaller group of stocks to get better insights. And what I do usually is just start out with the S&P 500 companies. And to narrow down to the S&P 500 companies, I'm going to use the filters here above. This one in ETF, we're going to drop it down and we get a list of ETFs. When you select one of these ETFs, the list below will get filtered by stocks that are holdings in that ETF. So let's try that. Let's say click on SPY. Now all the data below changed. Now we're looking at SPY holdings, which are the S&P 500 constituents. Here we see 14 stocks made our percentage gainers list, 12 on the decliners. So kind of even from that perspective, maybe a slightly bullish bias. And I think it's Friday, so we're not getting as many earnings coming out. It looks like maybe PayPal right there. There's an earnings that's on a percentage gainers list. Here's 2 on the decliners list, just reported earnings. And the stocks could be reacting to that news. So we gave a couple minutes for people to put in their questions. I don't know if you got any yet. If not, I'll just navigate to some other places.
Nothing's popped up.
Okay. So I get questions. These questions kind of come from people who start out trading or learning about our financial markets and learning about our you know, different financial instruments and analysis of those instruments. And some of the questions come out is, when I'm looking at the data and analytics, let's say, like, for example, I'll give you, yesterday we were looking at option order flow sentiment. And, and there's certain data that we know that is, it's raw data or it's concrete, and we know what the data is. Like a stock price, we know that stock price traded at this price. So that's something that we know for sure. But then there's other data, and this is going to be in most finance, where you're taking raw data and then you're trying to make inferences of what's going on, because there's no other way to get to answer those questions. And I'll give you, before we go into, stocks and options, because a lot of it, you're still making estimates based on the raw data. Could be, whether it's implied volatility, delta, gamma, option order flow sentiment. These are things that you stick to a methodology and you make inferences and estimates. And that happens a lot in finance. Like, take, for example, inflation, right? The Fed says, okay, our target is 2% inflation. But even inflation, our economy is very broad. There are prices changing everywhere. And you have to make an inference. What is inflation? Which means, you have to determine, your reference prices, what's included, what kind of adjustments are you making, what, are there numbers that you're throwing out, like the top numbers or lowest numbers? What are you doing, if the prices stay the same, but, the cereal goes down by 10%, what are you doing? So whether it's inflation, GDP, unemployment, almost all those numbers that you're seeing that we're tracking, where you're making inferences, you're making estimates based on raw data. So like sometimes people say, well, what does this probability mean, or what does this delta mean, or is this exact? It's a number based on the methodology, right? And we do that because we need some sort of reasonable inference, right? Your inferences, even the Fed is, no matter if you're a Wall Street bank or the Fed, or you're following models and you're always tweaking and making adjustments as you go. But these are, so it's kind of an important thing to understand that, when we're looking at models and, some derived values, they have assumptions and inferences all the time. And that exists everywhere in the, in the financial world, whether you're even tracking, national housing prices, you're still making inferences, how much weight you're giving to, places. Are you using the median? Are you using the average? Are you taking out outliers? What type of houses are you including? Are you including multifamily, single family? What, all these, are estimates that we start, reasonable estimates to start tracking things, right? That's what I kind of wanted to get into. So like, even over here, let's say we take a stock, take like Tesla. Here, I'll open it up. This is Tesla. It's trading in pre-market hours. And we'll go here. These are its pre-market hours, prices and volumes. And if we take a breakdown of the volume, there's certain things we know, like, for example, we know where the prices have traded. We know the volume. So we could get a volume profile of, over here in the gray, where did most of that volume trade? What price? So I'm hovering over here. VWAP price between 202.89, 203.41 was the bulk of the volume. That's where it traded. See here, and then we could get a distribution of the volume and price. Here on this side, we have a breakdown between lit exchange and dark volume. So that we also kind of know, right? Because that is, concrete data. All we're doing is just kind of assembling it and saying that, well, right here between these prices, like over here, we see that, 647,000 of that volume was in a dark pool, and I could cover over 915,000 were in the lit exchange. So I could see that more of it was tilted towards the lit exchange than in the dark pool. But then we go into the middle, right? And when we go into the middle part of it over here, well, what part of that volume was small trader, retail, professional, institutional? Well, that part, although, you may find that information valuable, nobody gives it to you because we can't go into every brokerage firm and every broker dealer and everybody who has access to the exchange and see how much they have in their account and what was their intent and so forth to classify them as a small retail trader, retail professional, institutional, right? We don't have that ability. Nobody does. Even if one broker may have insights into their own customers, they don't see other customers where there are millions of people coming into the markets and trading. So we can't really know concretely where this is. So we do have to make some estimates based on analysis of the data. All right. So what I'm trying to kind of point is, okay, we want to try to answer a question, but we don't have, nobody has those concrete answers, but there is data that we could use to make certain inferences. Okay. And what are some of the inferences we could make? Well, if, for example, we see a very large block trade for $1 million worth of stock, or we see a huge spike in volume that sweeps the book for $1 million almost simultaneously, well, we could make an inference that is not likely a small retail trader with $2,000 or $3,000 in their account, right? Because they will not be able to even enter that order, right? And it's not likely a retail or professional buying a big block of 1 million shares of stock, or sweeping the book for $1 million worth of stock that quickly, because they don't even have access to that type of order anyway, most likely, and we wouldn't even classify it. And also, if we see a trade that is, for 3 shares or 1 share or 5 shares or anything that is not very, a big notional trade, and we don't see any surrounding trades around it, right, that we could connect to, it's part of another bigger trade. Well, if we see that, then most likely that's not a huge institution, doing that trade. The initiating trade was small retail, right? So we start classifying this. Remember, we're trying to create an estimate, so we can't do 100%. Just like we don't know 100% what did our GDP grow. We can't. There's no way to actually, say, well, how much value did everybody's service, add to the overall GDP. So by creating a methodology that is reasonable, with what we think is a higher degree of reasonable, we could kind of paint a picture what we think is going on. All right. So, and this is one example of showing, okay, based on looking at all the different trades, analyzing the pattern of historical trades and analyzing the time differences between the trades, the sizes of the trades, all this, and our algorithms doing it, we kind of try to get ourselves a picture of what type of players are participating at different prices. Okay. And here in Tesla, it looks like it's kind of fairly distributed, like nothing really big, sticks out to me. But, the idea is that we want to try to paint a picture, and sometimes we do have to use our own logic and surrounding data to come up with an estimate. All right. And it's important that happens with implied volatility, that happens with deltas and gamma, because it's a model, right? Delta, gamma, vega, implied volatility, you're still putting it in a model with assumptions. And that model itself, it's not a formula. It's actually a model with logic and working a tree backwards to get to the implied volatility. I wanted to bring that up because sometimes I get that question, is this exact, or is this, not in financial modeling? Even when you're looking at things like, some financial ratios, where they also have assumptions in it, right? They have, if you take earnings per share, right? If you take earnings per share and you go through all the different industries, you're going to get different variations, right? So there's a gap number, and then there's like another number where they tell you, well, this is what we think their earnings per share. So if you guys trade REITs, you will know what I'm talking about, right? REITs don't even use their earnings per share. They use, what do they use? The FFO, funds from operations. If you look at banks, they use a different, different methodology. Insurance companies, they'll use a different to calculate their free cash flows. So there are all these different things that we use to make inferences and estimates in financial modeling. Okay, and there could be a debate if you're doing it right, or I would do it differently. But that's basically, what I wanted to kind of point out. Right? No questions, Will. I'll move on.
No questions yet on that, Pete. Thanks.
Okay.
We did have a question from Rob, though, and it was revolving around Mike's situation of rolling an options contract. I don't know if you want to look at that.
Okay. Well, yeah, what's the question?
All right. When you have a covered call that is now showing a loss because the stock has rose above the call strike, but the call can be rolled to a higher strike at a future date, does that give you a chance to gain back part of your loss if the stock falls in the future? So I guess that's just rolling. If you own the stock, just rolling. Maybe how do you look at that? I don't know, Rob, if you want to come in and ask particulars about rolling. It looks like there was maybe I don't know if it was a naked call or a part of a buy rate, but the stock has risen above the call,
right?
And he's looking to potentially roll it. I guess maybe reinitiate, not get the stock called away, maybe.
Right. Okay.
It was in Tesla, I think.
Okay, so in Tesla, I'll go to Tesla. So a couple things about the buy rate strategy or a cover call. And for those of you who are trading it, you own a stock, let's say Tesla, and if you believe that Tesla, you don't want to sell the stock, but you believe like Tesla is gonna, kind of sit here, or maybe drop a little bit, or maybe go up a little bit. What the buy rate strategy allows you to do is write a call or sell a call against your stock position. Right? The idea is, well, if I sell this call, let's say 220, right, for $10, $10.25, and I own 100 shares against it, right? So at expiration, right? Here's $10.25. Here at expiration, I'll make that premium as long as the stock, right? But you could, well, here it looks kind of like a synthetic put, which is really, that's what it is. You're selling a synthetically, you're selling a put when you're doing a buy right. But the question is, well, what do I do if the stock went above this strike? So at expiration, if the stock goes above 220, right, above your strike, it goes above 220. Well, what will happen is that you'll get assigned, and they're gonna take away the stock. So you're no longer. It's like selling the stock at $220. In effect, you sold the stock at 220 at expiration, right? You get the 220 per share, and then whatever you received for the call price. So it will be a winner at that point, but you're done with the stock. It's like you don't have any more position afterwards. And if you roll it, it's really it's up to you, right? If you roll it, or if you want out of the position, that you have to really consider yourself, what I want to do. But here's the thing to consider. Let's say you held Tesla for a long time, right? Let's say you held it for 5 years. If you allow this to happen and you get assigned, well, then you're going to pay a capital gains tax on that stock, right? Because it's like the same effect as selling it. So even if you buy back Tesla, let's say the next day, you still owe that stock. Let's say you're sitting, if you bought Tesla, let's say at $100, it's 207. Well, you're sitting on $100 of unrealized profits, right? Until you realize them, you're not paying the capital gains tax on it, right? That's, so far, those are the rules. And if you do sell it, you have to pay capital gains tax. So the thing to consider, that if you're doing this strategy against a stock that you own and you're sitting on capital gains and you don't want to sell the stock, you want to continue holding that stock, if that happens to you and it crosses the strike, you have to close out of the call, right? You'd have to buy back the call. You could roll it up to a different expiration and a different strike, or you could just close out of the call. But if you don't close out of the call and your stock gets taken away, it's going to trigger a taxable event, right? So it's something you should be considering, and it's not a tax advice. You go talk to your tax, right? I'm not even, I'm not a licensed tax person, but that's really the laws are right now. If you're sitting on unrealized gains, until you sell it, you're not paying the capital gains tax on it. But once you pay the capital gains tax on it, like, think about it this way: if I sold it, right, and I'm sitting on $100 per share profit, well, now that $100 per share profit, I need to pay taxes, right? I need to pay the tax on it. So if I'm buying back the stock afterwards, you have to buy back less stock, right? You already paid capital. So it's something you should be considering depending on your situation, right? Talk to your tax accountant, whatever, but it is something you want to consider if you're in that situation. As far as rolling it, if you're, I understand the question. If he's saying he's sitting on a loss, I'm not sure what he means by a loss, since the stock would have had to go in his favor. So that part, I'm not sure what that means, but right, because if the stock goes up and passes your strike, it went in the direction, in the profitable direction. So I'm not sure I understood that part.
All right. Well, anyone can come on live and ask questions by clicking the link. We're right near the close. Anything else, Steve? Actually, a reminder, we have a webinar with Felix Fry on Monday at 7. I'll put a link in the chat. And we also have a webinar on Tuesday, correct, Steve?
Yeah, Tuesday. That one was with Interactive Brokers. You have to register with Interactive Brokers to see that webinar. They're hosting it. They're doing it, we're doing it in conjunction with Interactive Brokers. So you do have to register for it. It's not going to be on YouTube like these other webinars, but it'll get posted on the Interactive Brokers platform.
Yeah, and that's a different link. I know Alex, who came in. Morning, Alex. He emailed me yesterday, and that is to find all those webinars. You just go to the IBK, just type IBK webinars in Google, and you'll go to the page. I mean, they have actually all of our webinars on file because we've done over 1.5 years of webinars with them. So that's pretty cool.
Right. So, yeah, that's going to be 2:00 next Tuesday on Iron Condors.
Iron Condors.
Talking about Iron Condors. All right,
my friend. You have a good weekend. Thanks so much.
Thanks everyone for joining. Stay safe out there. Have a great trading day, and we'll hope to see you guys on Monday.